Welcome to your weekly market update. We've seen interest rates climb, climb, climb. Remember, this is mortgage bond trading. Green is good, red is bad. Lower on this chart means higher mortgage rates. We hit the highest interest rates in the last 16 years since November of 2007. Good news is this line right here held, and now we are seeing a rally, hopefully to work back up to this line right here. So what are some of the reasons why this is happening? Continued hawkish comments by the Federal Reserve saying they're not done. They don't seem aligned. A big conference is on Friday in Jackson Hole. Hopefully, Jerome Powell put some calmness to the markets. U.S. debt being downgraded, meaning there's a risk of treasury bonds not being paid by the U.S. government because of the continued spending. Unfortunately, the Fed is now looking at the job market as being the catalyst for inflation, which I think is ludicrous that we have a governing body that is rooting against job creation and wage increases. I thought that was the point of this country. I understand how that impacts inflation, but a ratio is a ratio. If people are making more and prices are more, what does it matter what the price is as long as wage inflation is outpacing cost of goods sold? So to me, it's ludicrous. It's like the government rooting against job creation and job growth, which I just can't get behind. However, these are the facts. These are what we're working with. So this will not last forever. Okay. Some things to know about where we're at as a country. Yes, we are continuing to spend. Yes, the cost of goods is continuing to go up by small increments, but we're continuing to pay it. How are we paying it? Let me share my screen with you. Well, we're putting it on credit cards. If you look and see, we are $8,000 median balances on a credit card. It was $4,000 this time last year. Unpaid balances are up over 16% over last year. 12-month balance rose to $270 billion on credit cards. And remember, the interest rates on those are averaging about 24.5% now, and delinquencies are up. So we are funding this with credit card debt, which is not good. Good part of our economy is existing home sales. So as you can see, we're down a little bit. 16%. That's due to lack of inventory. Median home prices are down just 1% off the height of last year. So as you can see, even though the amount of sales are going down in real estate, prices continue to remain very strong. Here's what I thought was interesting. 42% of the buyers out there are either cash buyers or investors. So as a home buyer, you're going up against cash, you're going up against savvy investors that have a lot of capital behind them. When those two people and those two groups are buying, you should be buying. So that's your competition for the homes. You need to be aggressive in your offers. You need to be aggressive on your timelines. We can help with all those things. So I think the highest part of interest rates was seen on Monday and Tuesday of this week. We're seeing a lot lower rates as of today, as I showed you on the charts, which is good news. But it will all come down to what the Fed continues to make their policies, and most importantly, what they say. So let's hope that they get aligned and can have a unified message that these rate hikes need to be paused and need to have time to circulate our economy. If we can do anything for you, give us a call, 312-731-4939.